A very good afternoon and warm welcome to all the students to the digital classroom of Advanced Accounting and Auditing Paper 6. I, Professor Shaurya Shah, welcome you all to this lecture. Dear students, as we had discussed in the last lecture, the syllabus and the basics of ratio analysis. I hope everyone must have referred once again with the ratio analysis formulas and the sum that we had solved in the last lecture. Again, today we will be continuing further with the another two types of ratios, that is basically activity ratios and you have proprietary ratios. Fine. But before going on further, a brief introduction and brief revision of what we had done in the last lecture. We had seen the meaning of ratio analysis, how a ratio is expressed. Then we had seen the various classifications of ratios, liquidity ratio we did in the last lecture. Then we had done profitability ratio also. Today we will be doing the activity ratio and capital structure, that is leverage ratio, also known as proprietary ratio. Fine. So we will be seeing the classification of ratios also we had seen last time. We had seen liquidity ratio, which includes mainly your current ratio and your liquid ratio or acid test ratio or quick ratio. We had seen the formulas for current ratio, current asset upon current liability. I suppose everyone must be aware of this formulas. You must have learned this thing. Then the next thing is your current assets. What do you include in current assets? Current liabilities. Quick ratio we had seen. Quick assets, quick liabilities. Profitability ratio. In that we had seen your first is GP ratio, then operating profit ratio, then net profit ratio, expenses ratio. So all these things we had seen in the last lecture. Again we solved one of the sums for operating ratio also. You calculated the various operating expenses, cost of goods sold, and on that basis we had seen the operating expenses. Now starting with today's part, dear students, we will be starting with the third type of ratio, that are activity ratio. Now what are activity ratios? These ratios are called efficiency ratios, or we can say asset utilization ratios or turnover ratio. The name itself says activity. Now what activity do we do in business? We generally purchase or sell. That is our main activity. So all these things are related to your purchase and sales of your activity, or it can be activity related to your assets. So which is the very first ratio you need to study? The most important is your stock turnover ratio, or the other name is inventory turnover ratio. Now what is inventory turnover ratio? This is the ratio that indicates the number of times inventory is replaced during the year. How many times the stock is changed is shown by stock turnover ratio. The name itself says stock turnover. How many times the stock is turning over, that is shown. What is the formula of that? It is COGS upon average stock. Just remember it, students, very well. This is the most important ratio. Again, short sums will also be there of 3 to 4 marks on this formula based only. There will be some particulars missing. Either stock turnover ratio will be given and COGS will be missing. Either average stock will be given and one of the things will be missing. So you need to be very again cautious about the formula. What is stock turnover ratio? It is cost of goods sold. What is cost of goods sold? We had seen it is purchase plus purchase expense less purchase return plus opening stock minus closing stock. That is your cost of goods sold. Now cost of goods sold divided by average stock. What is average stock, students? Opening stock plus closing stock divided by 2. That is my average stock. Now in some of the students there will be a situation where they will not give any opening stock. So there we can directly calculate on the basis of sales divided by closing inventory, right? So also remember the alternate formula. In most of the sums we will follow these two formulas only, but in some of the sums when it is missing, then we will see this particular formula. I hope it is clear, each and everyone. Fine. So stock turnover ratio is the first activity ratio. the next important activity ratios are your debtors turnover ratio. Now debtors turnover ratio or average collection period. What are it? These ratios are indicative of the efficiency of the trade credit management. Now, who are known as debtors? When a business is selling goods on credit, the person from which we need to receive the money are known as debtors. Now, debtors here is a broader concept. It includes your bills receivable also, right? So, a higher turnover ratio and shorter collection period indicate the prompt payment. Suppose if I say my debtors ratio is 25 days. So what does that mean, students? In 25 days, I am receiving the money which I had sold on credit for the goods, right? So in 25 days, suppose today is 1st of July. I am selling on 1st of July. So after 25 days, on 25th of July, debtor is going to pay me the money. So I ask you people, if I say my debtors ratio is 40 days, is it good or bad? And comparatively, if I say my debtors ratio was 30 days before and now it has become 40. So you all will think you are receiving the money in 30 days, but now you are receiving the money in 40 days. So it is not good for us because our working capital will be affected from that, because we will be having lesser cash on hand for our day-to-day business, right? So that's why it is said a higher turnover ratio and shorter collection period indicate prompt payment by the debtor. Means your turnover ratio is high and the payment is received earlier. On the contrary, low turnover ratio, that is your stock turnover ratio, and longer collection period indicates delayed payment by the debtor. This is your low turnover indicates your stock turnover ratio, right? So a higher stock turnover ratio is good because many a times our stock is turned over, and a lower collection period, right? So lower days we are receiving the money. What is the formula for that? Most important, debtors ratio is equals to debtors plus bills receivable divided by credit sales into days of the year, right? So here your year will be, students, mainly 365 days, but many a times in the sum they will say, okay, your year will be of 360 days. So you need to calculate according to the information given in the sum, right? So 360 days you will take, or whatever the info is given in the sum basically, right? So what is debtors ratio? Debtors plus bills receivable about credit sales into days of the year, that is 365. What is the main purpose? To know the average period of credit to ascertain the efficiency of credit department. I hope everyone is clear with that part. Fine. So till now we have seen stock turnover ratio, we have seen debtors ratio. Now the next is creditors ratio. Dear students, same like your debtors ratio, again our business is also purchasing from your creditors, who are known as creditors, from the persons from which you purchase it on credit. So creditors ratio is similar like your bills. Again we can say debtors ratio only. What is the formula for that? It is creditors plus bills payable divided by credit purchases. In that we saw it was your debtors plus bills receivable divided by credit sales. Here it is exactly opposite. Creditors plus bills payable divided by credit purchases into total days of the year. Again 360 or 365. What is the main purpose? To know the average period within which we make the payment for credit purchases. Now here students, higher the credit period, maximum working capital can be utilized, right? So here if we are having a credit period of 40 days and I ask you, earlier we were having a credit period of 50 days, which one is better? Definitely the 50 days, because I have to make payment after 50 days. So longer the period, better the working capital. I suppose it is clear. In debtors ratio it was opposite. Lower the period, better the working capital. I suppose everyone is clear with the creditors ratio. Fine. Just remember each and every formula very carefully. The entire chapter is based upon 14 to 15 formulas. The chart I will provide you in the Google Classroom. I suppose it is clear everyone. Now in the activity ratio, The next ratio is your total assets turnover ratio. What do you mean by total assets turnover? It is to know the efficiency with which total assets are utilized in the business, right? More number of times the assets are turned over, it shows the lower efficiency of the business, right? Means our usage is not up to the optimum level. So for achieving the optimum level, sales upon total assets we calculate, right? How much is our sales and how much total assets are there. This ratio shows you the efficiency with which assets are utilized in the business, because more the sales will be recovering from total assets, right? Is it clear, students? Fine. This ratio is generally not asked in your exam, but for your knowledge we will practice this ratio also. So activity ratio, we saw 4 things. Again, very quickly revising those things. The very first is your stock turnover ratio or inventory turnover ratio. What was the formula, students? It was cost of goods sold upon your average stock, where average stock is your opening stock plus closing stock divided by 2. In cases if your closing stock is given but opening stock is not given, so what will be your STR? STR will be sales upon closing stock. Next we saw was debtors ratio. Debtors ratio is your debtors plus bills receivable divided by credit sales into days of year. I suppose it is clear, each and everyone. Next we saw is creditors ratio. Creditors ratio is your creditors plus bills payable into days of the purchase, days of the year upon credit purchase. Is it clear, everyone? And the last, sales upon total assets, shows you total assets turnover. I hope each and everyone is clear with activity ratios. Fine. Now we will be moving on to the last head of the types of ratio. The last head of the type of ratio shows you the capital structure or leverage ratios, right? All these things are based upon your liability side of your balance sheet. The various ratios are debt equity ratio, proprietary ratio, capital gearing ratio, debt to total capital, and interest coverage ratio. Out of this, debt equity ratio, proprietor ratio, capital gearing ratio, and interest covering ratio are the 4 most important which are asked in every sum. Students, keep in mind, a long sum of 14 marks will be asked, and again it will not be a direct question. Some of the things will be missing. On the basis of that you need to find out. So if you are thorough with your formulas, you can easily calculate the sum. I suppose it is clear, everyone. We will be starting with the first ratio, that is proprietary ratio, right? What do you mean by proprietary ratio? Proprietor, you must be aware of the term. Proprietor is the synonym of owner. So what is proprietary ratio? This ratio indicates the general financial strength of the firm and the long-term solvency of the business, right? So what are your total proprietors fund? This ratio is calculated by dividing proprietors fund by total funds. So what does it indicate? It indicates the financial strength of the firm and the long-term solvency of the business. The total funds, the total assets, and the owner's fund. If owner's fund is more in amount, it will show the, again we can say, financial strength of the business, right? What is included in proprietor's fund? That is the most important part you need to study. Proprietor's fund are same as explained in shareholders fund, right? Shareholders fund includes your equity, includes your preference, includes your reserves and surplus. Is it clear, students? And it also the fictitious assets are deducted from it. Total funds are all the fixed assets and all current assets. Take into mind, students, very carefully here, there will be no fictitious assets included. Total assets are your real assets which you are having in your business. So what are your total funds? Total funds are all the fixed assets and all the current assets. Alternatively, it can be calculated as proprietor's funds plus long-term funds plus current liabilities. That shows you the actual liability side of your balance sheet. Is it clear, everyone? Fine. So what is proprietor's ratio? It is proprietor's fund upon total funds, or we can say total assets. Is it clear? Fine. The next part is your Debt equity ratio. What do you mean by debt equity ratio? The ratio itself says debt, equity, and the ratio between debt and equity. So this ratio indicates the relative proportion of the debt and the equity in financing the assets of the firm, right? What is the debt? What is the equity? How much assets are purchased from debt, that is borrowed capital, and from equity, that is owner's capital. So it is calculated by dividing the long-term debt by shareholders fund. How much is your long-term debt and how much is your shareholders fund? I can come to know. Ideal ratio depends upon the size, type and nature of the business and the degree of risk involved, right? There is no ideal ratio for any business. You just need to remember the main formula for debt equity ratio, that is long-term debts upon shareholders funds, right? How much is my long-term debts and how much is my shareholders fund? Always remember the first word is debt. That is why in numerator debt will come. Equity, it is the denominator. That's why shareholders fund will be in denominator. I suppose it is clear. The first we saw was proprietors ratio. The second we saw was your debt equity ratio. Now the third. Here the long-term funds are loans, whether secured or unsecured, like debentures, bonds, loans from financial institutions, etc. Right? So students, it includes your debentures, bonds, loans from financial institutions, etc. As you all know, long-term funds includes this thing. Shareholders funds are the equity share capital plus preference share capital plus reserves and surplus minus fictitious assets. It can be any fictitious asset, maybe preliminary expenses, past accumulated losses, advertisement suspense, then discount on issue of shares, then it may be any kind of losses which is not yet written off, P&L debit. So just remember, shareholders fund. Shareholders fund is the actual owner's fund. So what does it include? Equity share capital plus preference share capital plus RNS minus fictitious asset. And long-term funds include all the long-term borrowings from the market. I suppose it is clear to all the students. Fine. Moving on is your capital gearing ratio. Again, important from your examination point of view. What do you mean by capital gearing ratio? The name itself says capital gearing ratio. This ratio indicates the relationship between fixed interest bearing securities and equity shareholders fund. They gear the capital. That is why the name is capital gearing ratio, right? Who gears the capital? The fixed income bearing securities. Now fixed income bearing securities includes various kinds of people. That is your, again we can say debentures are there. Then you have various kinds of loans are there. These securities are fixed interest bearing. You need to pay them interest divided by equity shareholders. That is why it is equity shareholders fund. I suppose it is clear. So what is the formula of capital gearing ratio? Capital gearing ratio is fixed income bearing securities divided by equity shareholders fund. So first we saw proprietors fund, that is proprietors ratio. Second we saw debt equity ratio. Third we saw capital gearing ratio. Is it clear everyone? Fine. You just have to continuously note this down also very quickly. When I am discussing the ratio, you have to first write it down, right? Then only you will be clear with the formulas. And in every sum, you need to first write down the formula. Then you need to solve the sum for that particular part. I suppose it is clear. And the last is your interest coverage ratio. What do you mean by interest coverage ratio? This ratio measures the debt servicing capacity of a firm. It shows how many times the interest charges are covered by earnings before interest and tax, that is EBIT, out of which they will be paid. EBIT divided by interest, right? So what is your EBIT? It is your earnings before interest and tax. So EBIT divided by interest shows you that how many times your profit before interest and tax is compared to your interest. Take for example, if my interest is 100 rupees and my EBIT is 400 rupees. So students, if I ask you what will be my interest coverage ratio, it will be your 400 divided by 100, that is equals to 4 times, I suppose, right? So 4 times is my interest coverage ratio. more the interest coverage ratio, better the position of the business, because you are knowing that your interest is covered in the profit very well in quantity. Is it clear, everyone? Fine. So what is your interest coverage ratio? Once again, EBIT divided by interest. And the last, it is your long-term funds to fixed asset. To see how many fixed assets are purchased from long-term funds, right? So total long-term funds divided by fixed assets. So you will come to know about the long-term funds to fixed assets ratio. I suppose it is clear. So today, students, we saw particularly in activity ratios, we saw stock turnover ratio, we saw debtors ratio, we saw creditors ratio. Is it clear, everyone? Then we saw one total assets turnover ratio. After that, we started with capital structure and leverage ratio. In there, the very first we saw was proprietary ratio, then the second is debt equity ratio, capital gearing ratio, then we saw interest coverage ratio, and at last we saw the long-term funds to fixed assets. I hope it is clear, everyone. Any doubts? You can very clearly specify in Google Classroom. We are here to help you out with your queries. You just need to prepare a list of formulas right from the very first lecture to till now. Then it will be very easy for you to solve the sums. Now we'll be beginning, students, if you all are clear, with the short sums. In the last lecture, we solved one short sum of your operating ratio. Today again we'll be starting with the university short sum. What is the sum all about? Only this info is given. This sum is for your 3 marks, students. Keep in mind, you need to be very quick and you need to be very efficient in your solving the sums about your ratio analysis. You need to think very fast. What is given in the sum? It is basically VNSU 2007. Current ratio is 2.8:1. Okay, now whenever this kind of sums are there, always analyze first what is given and how can it be calculated, if any similarities are there or not. So the very first thing is current ratio. Current ratio is given in the sum, that is 2.8:1. So what does current ratio suggest? Current ratio suggests you, students, current assets upon current liabilities, right? So what is it? I can say current asset is my 2.8 and my current liability is 1. Is it clear? So the very first thing you need to see. Liquidity ratio is 1.5:1. Okay, so from this liquidity ratio you must be knowing the formulas. We do not consider stock in it and we do not consider bank overdraft. So I can see one thing, that liquid liabilities and current liabilities are same, as it is 1:1. Okay, working capital is given 1,62,000, students. What do you mean by working capital? Working capital is current assets minus current liability. So from this 3 info I can calculate further. Again, what is given? There is no bank overdraft in current liabilities. Okay, so it has made my point easy, that again liquid liabilities and current liabilities are the same, as bank OD is not there. Find out current assets, current liabilities and liquid assets. 3 things we need to find. Okay, so how we will proceed? Again, I hope you must have written the sum. Current ratio 2.8:1, LR is equals to 1.5:1 and working capital is 162,000. Fine. Now starting with the sum, basically I have one link, that is working capital. Now whenever such kind of sums are there, always start with the amount which is given in the sum, students. Working capital, we will start, right? So what is it all about? You need to study. That is your current assets minus current liabilities, right? So again we will see the solution for that. So you just please note it down, whatever I am saying, then what is your current assets, right? So here your current assets will be, first of all, starting with the working capital. So working capital is equals to current assets minus current liability, right? So what you need to do, students, is working capital is equals to current assets minus current liability. So I am having an answer in the sum. Current asset is equals to 2.8, that is my 2.8, minus I am having the value of current liability, that is equals to 1. So what you need to do is working capital is equals to 1.8. I suppose it is a bit tricky. I had the solution in the PPT, but somewhere it is missing, so you may understand this. You can write it down on your book. Working capital is equals to current assets minus current liability, that is equals to 2.8 minus 1, that is 1.8. Now students, you must be knowing, if you have value of working capital is equals to 1.8, right? So what I can do is, as we were comparing earlier, so if I am having two values, I can compare. If my working capital is 1.8, that is equals to 1,62,000. 1.8 is equals to 1,62,000. So how much will be my 2.8 equals to? As we were having the small equations that we will see in the sum. So this will give you the answer of working capital as 2,52,000. That is my answer of current assets, because you all are knowing that current assets is my 2.8. Is it clear, everyone? I suppose, right? So that is equals to 2,52,000. So on the basis of working capital, I will get the answer of current asset, because 1.8 is my working capital. So that is equals to 1,62,000. So what will be my 2.18? So current assets I'll get, that is my 2,52,000. I suppose it is clear, each and everyone. Any doubts in that? No. Fine. So we have found out the answer of current assets. Now there is a next step to calculate current liabilities. What do you mean by current liabilities? As you must be knowing, working capital is equals to current assets minus current liability. I am having the answer of working capital 1,62,000. I am having the answer of current assets 2,52,000 minus current liability. So taking current liability on the right hand side and taking working capital on the left hand side, you will be able to find out current liability is equals to 90,000. I suppose everyone must have got this answer. So current liability is equals to 90,000. Is it clear? Okay. Now the next thing, as students, here is your liquid asset. Now liquid asset, how you will be able to find it out? Liquid assets, you need to just simply calculate on the basis of liquid ratio. Liquid ratio in the sum they have given is 1.5 is to, liquid ratio they have given is 1.5 is to 1. So if my liquid liability is 1, my current liability will be, assets will be 1.5. So if my liquid liability is 90,000, as you know there is no bank OD, what will be my liquid assets? So that will be equal to into 90,000 into 1.5. So that will give me the answer of 1,35,000 rupees. So very quickly once again I'll tell you the answers for that. What is it all about? Current assets we have found out 2,52,000. Current liabilities we have found out 90,000, and liquid assets we have found out 1,35,000. Is it clear? Again, I'll provide you the notes and this sum also in Google Classroom before the next lecture commences. so that you can solve the sum and you can find out the solution for it also. Is it clear, everyone? Fine. Now one more sum for you people. This is your VNSGU 2013. You need to find out. Okay, VNSGU 2013. This is a sum which is a kind of homework for you people. I'll show you the question. We will discuss the question in the next lecture. I'll show you the solution for the same. What is given? Net profit before interest and tax is given, that is 12 lakh rupees. So this is your NPBIT, right? Before interest and tax, EBIT. Tax rate is 50%. Sales is 13 lakh 75,000. Debentures is your 10 lakh, that is interest rate is 10%. Equity capital is given 20 lakh. Preference share is given 10 lakh. Right? Find out net profit ratio and return on investment. Now what you have to do, students, here is, for finding out first the net profit ratio, you need to find out profit after tax. So what you all will do is, here it is given before interest and tax. Always remember, what students makes the mistake is they calculate first the tax. That is incorrect, right? The name itself says before interest and tax. So what you will do is 12 lakh less interest. Interest on what? Interest on 10% debentures. That is 10 lakh into 10% is 1 lakh. So what you will do is net profit 12 lakh minus 1 lakh interest. So remaining amount will be 11 lakh. On this 11 lakh you need to calculate 50% corporate tax. So 11 lakh 50% tax is 550. 5 lakh 50,000 will be given as net profit after tax, right? So on this you will be calculating the net profit ratio. So easily you can find out on the basis of this net profit after tax, that is 5 lakh 50,000 divided by sales, that is 13 lakh 75,000. Answer you will be getting, we will be seeing in the next lecture. The second part they have asked is your return on investment. What do you mean by return on investment, students? It is your profit before interest and tax divided by capital employed. Profit before interest and tax divided by capital employed. So profit before interest and tax already given in the sum 12 lakh. Capital employed you need to find out. Just one hint for you, capital employed includes each and everything. It includes your owner's fund, it includes your borrowed capital, it includes your long-term borrowings. So here we are having equity share capital, we are having preference share capital, and we are having debentures. So 20 lakh plus 10 lakh plus 10 lakh is your 40 lakh. So PBIT is 12 lakh divided by 40 lakh, the answer you will be getting, right? I suppose it is clear to each and every student. Next lecture I will show you the solution for both of the sums. I hope you will practice once again this sum, and you will prepare a list of all the formulas and go through it once again, right? I suppose each and everyone should learn the formulas so that when we are solving the long sum, very quickly you can relate it and you can find it out from the particulars. Any doubts, any queries, you can surely give in the Google Classroom. Again, for you people, there is one question for testing your knowledge. In the last lectures, we saw the following 3 questions which you solved very correctly. One question for you people. Current ratio is 1.6. If current liabilities of rupees 20,000 is paid, what will be the effect on current ratio? I suppose you must be getting the answer very quickly. What is the effect? Current ratio is 1.6. So I can say current assets will be 1.6 and my current liability will be 1. So if I say that I have paid the liability, so my liability will increase or decrease, students? Yes, definitely it will decrease. So my current assets, take very good example. Suppose my current assets are 1 lakh rupees and my current liabilities is 80,000. So 1 lakh divided by 80,000, right? Now my current liability becomes 80,000 minus 20,000 is 60,000. So 1 lakh divided by 60,000. Always remember students, whenever such kind of current liability decreases, your current ratio always increases. Whenever your current assets decreases, your current ratio decreases. Is it clear, everyone? So this was again short sum asked in university. Just you need to calculate the basic thing of current ratio. I suppose each and everyone is clear with your part. Any doubts? Fine, you can get it to Google Classroom. We'll be meeting soon in the next lecture. This is Professor Shaurya Shah teaching you Advanced Accounting and Auditing Paper 6 FORTYBCOM Semester 5. Have a great day ahead, students. Thank you for your valuable time. Take care. We'll meet soon in the next lecture. Thank you, everyone.